You open your 401k statement and you see a big number. Maybe it's $300,000, maybe it's $700,000. Maybe if you've been consistent and disciplined, it's getting close to $1 million. And when you see that number, you feel something powerful. Relief, pride, security. You tell yourself, I made it, I did the right thing. But here's the truth most people never say out loud. That number isn't fully yours. A large portion of that money already belongs to someone else, and they are in no rush. They're waiting quietly in the background, waiting for the moment you retire, waiting for the moment you start withdrawing, waiting to take their share, the IRS. Because with a traditional 401k, every dollar you take out in retirement is treated as ordinary income, taxed at whatever income tax bracket you fall into at that time, which today ranges roughly from about 10% up to 37% at the federal level, before even considering state taxes. So in many cases, that retirement number on your statement might face a combined bite of 20, 25, even 30% or more once you include federal plus state tax. That means your $1 million retirement might actually be closer to $700,000 in real, spendable money. And the most dangerous part? You don't feel it. Your brain has already labeled that big, round number as yours. This is the 401k tax time bomb. It's not a market crash. It's not a bad investment. It's a delayed cost, hidden in plain sight. And in this video, we're going to break it down. The psychology behind it, the real math behind it, and how to take back control before it's too late. The entire traditional 401k system is built on one simple promise. You'll pay less taxes later. That's the pitch. You contribute today, you get a tax break now, and you pay taxes when you retire. Supposedly at a lower rate because your income will be smaller. On paper, that sounds logical. It sounds efficient. It sounds like a smart hack. But there's a problem. That assumption depends entirely on the future, and the future is not guaranteed. Tax rates change. Governments change. Policies change. Over the last century, the top US marginal income tax rate has swung from as low as 7% all the way up to more than 90% during certain periods, before settling into the 30 to 40% range in recent decades. Today's top rate of around 37% is actually well below the long-term historical average of more than 50%, which means it's not crazy to imagine rates going higher again at some point. So what are you really doing when you put money into a traditional 401k? You're accepting a small, certain benefit today, a tax deduction this year, in exchange for a large, uncertain tax bill tomorrow. And your brain loves that trade because of something called mental accounting. Behavioral finance research shows that we mentally separate money into buckets and often overvalue immediate visible gains, like a tax refund or a smaller tax bill, while discounting future invisible costs. You see the deduction on your paycheck today, and it feels like a win. The future tax bill? That gets pushed into the background, out of sight, out of mind, until one day it becomes very real. Let's simplify this. Every dollar in your traditional 401k has a hidden label on it. Taxes not yet paid. Your contributions went in before tax. The growth has never been taxed. So when you withdraw, the IRS treats every dollar as taxable income. No basis, no step up, just income added on top of whatever else you earn in that year. That means the more your account grows, the more your future tax liability grows with it. People celebrate the growth of the balance, but almost nobody calculates the growth of the government's share. Traditional 401k withdrawals are taxed at your ordinary income tax rate at the time you take them, which depends on your total income, social security, pensions, part-time work, all of it, plus your 401k withdrawals stacked on top. A large withdrawal can even push part of your income into a higher tax bracket, making that slice of your money more heavily taxed. So the risk isn't just, what if my investments go down? The real risk is, what if the rules change around how much of this I get to keep? If tax rates go up in the future, you don't just lose a little bit more. You lose a percentage of everything: your lifestyle, your monthly withdrawals, your flexibility to choose how much to spend and when. So the real question is not, how big is my 401k? The real question is, how much of it do I actually get to keep? This is where it gets uncomfortable. Why do so many people resist thinking this way? Why does talking about taxes on their retirement account feel almost taboo? It hits something very specific in human psychology: loss aversion. Decades of research in behavioral economics show that people feel losses about twice as intensely as gains of the same size. When you imagine 25% or 30% of your retirement savings getting siphoned off by taxes, it feels like someone is taking your money away. But here's the twist: that loss was baked in from day one. It was always there. You just didn't feel it yet. Because the cost was delayed. No immediate tax today, no pain today. Your brain never flagged it as a threat. This is myopic loss aversion. We focus on short-term pain and short-term gain and underestimate long-term consequences. You got the short-term win of a tax deduction and never emotionally registered the long-term bill attached to it. So instead of confronting the future loss and planning around it, most people simply ignore it. They don't model it. They don't stress test it. They just look at the pre-tax balance and assume it's theirs. Now think about this from a generational perspective. For many people, especially those who grew up watching parents or grandparents struggle with inflation, job loss, or financial instability, control matters. You don't want surprises. You don't want to be dependent on a system that can change the rules halfway through the game. But a traditional 401k by design requires trust in forces you don't control. You have to trust that tax rates won't rise dramatically in the decades between your first contribution and your final withdrawal. You have to trust that future governments won't change retirement tax rules in ways that hurt savers. You have to trust that the system will remain predictable. Meanwhile, the retirement landscape has already changed. Older generations often had defined benefit pensions, where the employer or the government guaranteed a certain payout. Today, the shift has been toward defined contribution plans, like 401ks, where the responsibility and the risk sits on your shoulders. You decide how much to save, how to invest, and how to handle the tax risk. So what feels like the safe default strategy, just maxing out the traditional 401k and assuming the system will be fair, actually introduces a different kind of risk: uncertainty about your after-tax income in retirement. Let's make the math concrete. If you have $1 million in a traditional 401k and your effective tax rate in retirement ends up at 30%, you do not have 1 million, you have 700,000. The remaining 300,000 is already spoken for. It just hasn't been collected yet. Now compare that to money inside a tax-free structure, like a Roth 401k or Roth IRA, where contributions are made with after-tax dollars, but qualified withdrawals in retirement are generally tax-free if you meet the age and holding period rules. If you have 1 million in a Roth and you follow the rules, you keep 1 million. No surprise tax bill, no silent partner. This is the difference between paying taxes on the seed versus paying taxes on the harvest. When you use a traditional 401k, you're choosing to let your entire harvest, your contributions plus decades of growth, be taxed as ordinary income when you withdraw. And mathematically, the harvest is always bigger than the seed, which means the tax can be much bigger too. That doesn't mean Roth is always superior in every situation, but it does mean that ignoring the tax structure and only looking at the headline balance is a dangerous illusion.